5 seconds to the open. Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
All right, friends, welcome to this episode of the Follow the Money podcast. I'm your host, Jerry Robinson, and today's show is entitled Trade War Fallout. What's next for the markets? Well, we've got a lot to unpack today. You've probably seen by now the U.S. economy just threw investors a curveball, contracting by 0.3% in the first quarter in terms of the GDP print. Now, that's the first economic contraction that we've seen in around 3 years. You got to go back to Q1 of 2022 to see a similar economic contraction or a negative print. And it caught a lot of folks off guard. And, behind these numbers is that turbulent story of tariffs and trade wars and all the uncertainty that goes along with it, rattling not just Wall Street, but Main Street as well. And today, we're going to cut through a lot of that noise. We're going to break down what the latest economic data means for you, for your portfolio. We're going to dive deeper also into some charts. We're going to talk about what's driving the current slowdown. And most importantly, we're going to try to offer you some practical and actionable insights you can use right now. So buckle up. We've got GDP data, tariff impacts, we got payroll slowdowns, and of course the charts that matter most. Before we jump in, I want to remind you real quickly, if you find this episode valuable, be sure to subscribe and share it with your friends and head over to our website, followthemoney.com, for the latest investment and trading ideas and insights. So with all that said, let's jump right in. All right, friends, let's get right into it today. Let's talk about the latest batch of economic data because we're seeing that it's telling us a story that we better not ignore here. If you haven't heard yet, the U.S. economy contracted last quarter in Q1 by about 0.3%. Now, that doesn't sound like a huge number, does it? But here's why it caught economists and investors off guard is because the consensus around that print, around that GDP figure, was expected to be a modest 0.3 increase, actually coming after a very solid 2.4% growth rate in Q4. So what happened, right? What is causing this sudden reversal? Well, when you look at the chart showing GDP trends, you're going to see a dramatic shift. We were humming along in Q4, but then a sudden and sharp decline in Q1. The main culprits were due to a few things. First, there was a surge in imports to the United States. We'll talk about that in just a minute. And then there was also some notably weaker consumer spending, which also dragged the GDP down a little bit. You may recall from the old if you remember from economics class in high school, if you had economics in high school, many people didn't, or even in college, but you may remember the old equation for GDP, right? Gross domestic product. How do you add it? It's the total economic output for a country. The equation that you use is C plus I plus G plus EX minus IM, right? I always say, what in the world? Well, if you don't remember that from economics class, here's what it is. C is consumption, right? So we add up consumption. I is investment, so we add up business investment. And government spending is also there. That's CIG, right? And then you also add in the net exports, right? So that's exports minus imports. And when we look at the imports number here in the GDP, when we broke it apart, we'll see that imports alone soared more than 40% in the first quarter, and that created an enormous drag on the GDP calculation. And let me explain a little more clearly, because imports subtract from GDP because we're buying goods produced abroad. And you may say, well, why did we have a sudden surge of imports? Well, it's pretty obvious, right? What drove the surge? Well, we can trace it straight back to President Trump's Liberation Day tariffs and his announcement. So businesses and consumers were rushing to buy goods overseas before tariffs took full effect. And that means they basically front-loaded their orders, and this artificially exaggerated the import numbers, which created the illusion that our economic growth actually slowed dramatically. And so in some ways, we can kind of write that off as an aberration or just simply a temporary occurrence. But here's the thing. I mean, some of the data that we're looking at might seem pretty temporary, but we really can't dismiss it entirely as noise. I mean, the underlying picture, the demand overall is still fairly solid, but overall it's not that pretty. I mean, consumer spending, which is the backbone of our economy, it composes nearly 70% of our overall GDP on an annual basis. That slowed significantly. It rose just about 1.8%. And that's the weakest we've seen in terms of consumer spending since mid-2023. And when you see that kind of demand softening, it tells you something. It tells you that people are growing cautious, right? And you would say, why are they growing cautious? Well, because tariffs and uncertainty and higher prices on the horizon. And, speaking of tariffs, let's just talk about the elephant in the room. Remember that Trump's Liberation Day tariff hikes didn't officially take hold or actually hit until early April. It was actually April 2nd that was the day that it was announced. And so that's technically Q2. So businesses naturally rushed imports in Q1 to dodge these steep price hikes, but they didn't even really know what they were dealing with until April the 2nd. So that means we probably had even more front loading going on in the early part of April, especially after the reprieve that Trump placed upon those tariff hikes that were supposed to kick in, I think, April 9th or something like that. Well, anyway, there was a reprieve there. And so now all this front loading means that warehouses are getting stocked up temporarily, but we could soon see product shortages and inflationary spikes as the second quarter unfolds, especially in the retail sector. That's really what I'm focused on. In fact, we just had some of the top major retailers like Walmart and Home Depot and several others that met with President Trump. You may recall that they held a meeting with President Trump, I believe, at the White House. And after that meeting, we did get a little bit more of a reprieve from President Trump. But, Target and Walmart, they're already warning consumers to expect higher prices and fewer choices on store shelves this summer. If things go according to what retailers are suggesting, and if there are no changes, then it may begin to feel a little like deja vu from the COVID era shortages. But in this case, it's driven entirely by tariff-induced disruptions. And it's not just products that are going to be in short supply, goods on the shelves, but we can shift gears and look at the labor market. Private payroll growth just slammed on the brakes as well. According to the latest ADP data we got, April just saw 62,000 new private sector jobs. Now, we'll get the actual numbers on Friday, but that's the weakest reading we've had in nearly a year and barely half of what analysts were expecting. So that's telling us that employers are starting to hold back. Businesses aren't really laying off folks in droves, at least not yet. We did see UPS lay off 20,000 drivers after the Amazon situation, but they're clearly tapping the brakes on hiring right now. So we're not really seeing big layoffs across the board, but, we're seeing a slowdown for sure. And again, if you ask the question why, it's going to boil down to the same thing. It's uncertainty. In fact, uncertainty is becoming the new buzzword on corporate earnings calls. If you've been listening to any of the latest Q1 earnings reports, business leaders across various industries, from airlines to automakers, they're simply pulling their financial forecasts. I mean, American Airlines, General Motors, Snap, JetBlue, they've all yanked their guidance because there's still a ton of uncertainty around how these tariffs are actually going to land. And so when these big companies are saying we can't confidently predict the next few months, it's really like it's like a giant flashing neon sign to investors that storm clouds are definitely gathering. So markets are paying attention. We've already seen volatility spike very strongly this year. Investors are bracing for even more turbulence as we move forward. We saw, as I record this on Wednesday morning, the 30th of April, 2025, in the wake of the GDP report, we saw the markets come down fairly sharply at the beginning of the day. And they're still largely down, although they are trading off of some of their lows that we hit earlier. So if we continue to see weaker hiring and then more cautious consumer spending due to this uncertainty, then markets are going to react negatively. You can pretty much bet on it. Now, here's your key takeaway today. The data doesn't lie. Sure, there's some noise that's built into these Q1 numbers that we got from the GDP print, but the signal beneath is loud and clear. Uncertainty is rising, and economic growth is stuttering. It's stumbling. We can see it. And these tariffs are creating ripple effects that are going to challenge both consumers and businesses alike as we head into the coming months. So while the weak Q1 GDP print may not mean that we're facing an imminent recession right now or just yet, it certainly strengthens the case for more Fed rate cuts ahead. And in fact, I began the year telling our members here that we expected 3 Fed rate cuts, or I actually said at least 3 rate cuts by the Fed in 2025. Now, if you remember, at the beginning of the year, there was the expectation we wouldn't see any rate cuts because inflationary figures were still a little elevated. Well, all of this news that has come out, all of the tariffs, all the uncertainty, the slowdown in the overall economy, the spike in volatility, the slowdown in hiring, all of these things are pressuring the Federal Reserve. And of course, the Trump administration has been pushing the Fed to lower rates. And the next meeting for the Fed is coming up, I think it's May 7th is the next FOMC meeting. So it's just a week or so away. And currently, there's no it's very, very small, like less than 5% expectation of a rate cut at that FOMC meeting. I'd be curious to see if that changes and evolves as we get closer to it. Although I still don't expect a rate cut there. But I still expect at least 3 rate cuts this year. And I think we'll begin to see those maybe not at the May meeting, but probably at the next meeting in June. And so too with the full weight of Trump's liberation tariffs set to hit in Q2. Remember that he didn't announce it till April 2nd, which is the very beginning of Q2. So the economic data is likely to weaken in the coming months without an immediate reversal, of course, by the Trump administration. It's my opinion that we may not see a complete reversal from these tariffs, but I think we will see many concessions and probably big concessions made to prevent these tariffs from really doing too much damage to the U.S. economy, let alone the global economy. And this really puts the Federal Reserve in a pickle, trying to decide how to handle policy in this current environment. It's very crazy. And of course, if it's tough for them, of course it's tough for investors who are out there watching this, just unfold before us. So many of you are probably a little concerned. You're worried about what this might mean for the overall economy. Doesn't mean that we're heading into a recession because we've had now 1 quarter that's negative. Technically, you need 2 back-to-back quarters of slowing growth or negative growth to really justify a recession. And that's something that we haven't seen quite yet. There's still a lot of concern that we are maybe in a recession. I think we've been in rolling recessions now for some time. And what I mean by that is that we've been seeing recessions kind of hit various sectors or various industries, as opposed to just being a simple broad recession. But obviously, you're probably concerned. And so in our next segment, what I'm going to do is I'm going to dive deeper into the market. And we're going to look at what's happening on the charts. We'll see what they're telling us. And I'll provide my latest commentary. So stick around. You're listening to the Follow the Money podcast. I'm Jerry Robinson. We'll be right back.
Are you prepared for the next stock market crash? It's not too late to protect yourself and your family with Jerry Robinson's best-selling book, Bankruptcy of Our Nation, now in a new audiobook format. Whether you want to listen in the car, at the gym, or on your iPad, we've got you covered. Get the entire 300-page book in audio format for only $24.95. That's over 12 hours of Jerry Robinson's economic wisdom, financial insights, and practical money-making strategies for only $24.95. Inside this new audiobook, you'll learn 21 profitable income streams you can create both now and in retirement, along with unique tips on how to inflation-proof your investment portfolio using our own PACE philosophy, and our 5 levels of financial freedom, which is Jerry Robinson's personal blueprint for building true wealth. If your goal is to become a better investor, increase your income, or just understand what is really happening in the global economy, You cannot afford to miss out on the vital information that is jam-packed into this 12-hour audio book. Get instant access to Bankruptcy of Our Nation in audio format right now by going online to www.ftmdaily.com/bankruptcy. That's ftmdaily.com/bankruptcy. Download your copy today and get on the fast track to true wealth and a lifetime of financial security.
Hey friends, this is Jerry Robinson from Follow the Money Weekly. Recently, we have been receiving many emails from our listeners commenting on the great help they're getting from our precious metals expert, Tom Cloud. Gold and silver are excellent hedges against the growing threat of coming U.S. inflation. Who's your gold guy? Make it Tom Cloud. With over 30 years experience with precious metals, Tom will answer all of your questions. Don't buy your gold and silver through some call center and pay inflated prices. Call my good friend Tom Cloud and speak directly with him and get all of your questions answered. For a limited time, Tom is offering free shipping and insurance on every gold and silver purchase made by our listeners. Call 800-247-2812. And when you do, tell him that Jerry Robinson from Follow the Money Weekly sent you, and he'll throw in that free shipping and insurance on your entire order. Call your gold guy, Tom Cloud, right now for the very best deals on gold and silver coins. 800-247-2812. That is 800-247-2812.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Friends, you're listening to one of the longest running personal finance podcasts on the web. You're listening to the Follow the Money podcast. My name is Jerry Robinson. I'm your host, your guide, leading you on an excursion to truth right here every single time we do this podcast. You can find us online at followthemoney.com. Now, let's shift gears and let's chart some of what we've been talking about together. You know, I always say that it's important to follow the trend, not the opinions. And boy, howdy, are there a ton of opinions out there. If you listen to social media or turn on the financial media, you're going to hear opinions galore. And it's not that they couldn't be right. It's just that everybody has an opinion and nobody really knows what's going to happen tomorrow. So the very best thing that we can do is follow the trend if we're very curious about what might be going on, right? Instead of listening to so-and-so's opinion because we really don't know if that's going to be true or not, right? That makes sense. This market is certainly giving us plenty of trends to keep our eyes on right now. And let's begin by just taking a look at the granddaddy of all the markets here in the United States when it comes to equities, and that's the S&P 500 index. What is it telling us right now? Well, right now, the S&P 500 index is still in a long-term uptrend, if you can believe it. It is currently kind of unconfirmed in that uptrend, so it's right in between a new downtrend and an existing confirmed uptrend. So it's really challenged right now. It's in a very precarious place. Right now, the key areas that we're watching on the S&P 500 are the current level of about 5650, which is serving as overhead resistance. And what's interesting about that level is it kind of falls squarely between the falling 50-day moving average and the flat to also beginning to decline 200-day moving average. So that's kind of a key area we're watching. All the way up to about 5,800 is the area that we'd be watching, that 5650 to 5,800. If we can crack through that area, then it's very likely that we're going to get to a new high despite all of this. And the reason why is you have to remember that the market is not the economy. The stock market is not the economy whatsoever. The economy, when we get data like the Q1 GDP print, that of course is backward-looking data, right? It doesn't tell us anything about what's coming. It doesn't even forecast any of that. It's just telling us what happened, right? So when we look at the stock market, however, say like the S&P 500, it is not really looking backwards. It's really looking forward. The market is much more forward-looking. In fact, the market is usually looking about 6 months ahead. And that's why you'll often see pretty big divergences between economic data and the stock market. And so what I'm saying to you is that we're watching to see if this market begins to look ahead and begin to see brighter days and begins to rally into it. We've already seen that the market is trading well off of its lows. Like the S&P 500 got down to nearly 4,800. I think it was like 4,850 back in early April. You may recall that. That was a pretty scary moment as we were really seeing the stock market really begin to come down. It got a bounce. after the bond market started to quake a bit. I'm sure the Trump administration had to make some changes, had to make a few announcements, and they did, and it caused the markets to begin to rebound, right? As there was as the Trump administration blinked a little bit in terms of its tariff demands. So 4850-ish was the recent local low for the S&P 500. Right now, we're trading at about 5,500, right? So there's two key areas of support to watch here: the 5,400 level and the 5,200 level. If we violate both of those, it's very likely we're heading back down to that 4850 level. That would happen if the market, if investors are convinced that there is nothing constructive that's going to happen here. Now, I think investors are really trying to make sense of what's going on. And based upon what I can tell, this is just based upon what I'm hearing as I'm watching everything play out just like you are, I'm sensing that President Trump knows that he has a limited amount of time to be able to pull this stuff off. Because remember, in 2026, there's going to be midterm elections. And if people are still talking about this come midterms, if this is still an issue, if it's really caused a lot of businesses to lose money or go out of business, and if people are looking at their 401k statements and they've been cut in half come the midterms, I mean, that's just going to be a disaster for the Republicans. And remember, this is President Trump's final term. I know he's talking about a third term. You've probably heard that. That's a bunch of nonsense, quite frankly. What that really is it's a way to keep Republican contenders who want to run in 2028 under his thumb, basically. It's going to prevent anybody from kind of stealing the oxygen from the room. I don't think that Trump will run in a third term. I don't think that he's even necessarily going to try, although he may try. I guess you can't rule that out. But I think it's more of a tactic that he's using. You have to remember, Trump is pure tactic. I mean, he really is. He's quite a showman when it comes to this. And this is why many investors are saying this tariff, shtick is probably going to end sooner rather than later, right? We'll see. Those are opinions. We will see about all of that, right? But when it comes to the actual charts, the numbers, what we talked about, that's what we're watching there on the S&P 500. That's a very important figure. Now, when you look at the S&P 500 market breadth, you'll discover that about 35%, somewhere in there, about 1/3 of the stocks in the S&P are trading above their 200-day moving average. Historically, that is a good time to dollar cost average into the markets, and that's what we continue to do. In fact, throughout all of this chaos, we have continued our DCA Friday strategy, which we do with all of our members here. We share through our private Twitter feed and also through, X feed. And then we also share through our Trends and Profits webcast every single Tuesday what we are doing with our own long-term investments, how we are handling this. And what we're doing in 2025 is what we did in 24 and 23 and 22 and on and on. We're just dollar cost averaging into our favorite stocks, favorite cryptocurrencies. And if you want to know what we're buying each and every week, you just become a member here. You can know exactly, what we're doing and what we're buying. And that has really helped, I think, a lot of our members, not only to know what we're buying, but the fact that we are buying, right? That we're not running for the hills, selling everything here in this environment. I think we're going higher, guys. I think by the end of these 4 years with Trump, we will see that Bitcoin has gone much, much, much higher. Gold probably has plenty more upside ahead as well. There's very few presidents that have been better for the price of gold than Mr. Trump, considering all the debt that he tends to incur during his time in office. And that doesn't seem to be any different today. In fact, for the first 80 days, the Trump administration, the 2.0, the second Trump administration, has taken on more government spending in the first 80 days than we had in the first 80 days of 2024 or first 80 days of 2023. So the spending is off the charts as we head into into this new administration. And I don't think that's going to change anytime soon. In fact, they're trying to push through a new budget now, which is just extreme in terms of overspending. So that, of course, is that helps assets typically, especially whenever the Fed is if it's also going to be accommodative. If you have lots of government spending and then you have excessive amounts of QE coming from the Fed, it's just a recipe for higher prices for assets. And I think this current lull in the stock market is just a lull. I think we're going to see and it could last for a little bit longer. But when things turn around, I think we'll end up back in an uptrend. And this will have been a great opportunity for many people to accumulate high quality assets at a relative discount. Now, one of the markets that I focus on, one of my specialties, is the NASDAQ 100. In fact, it's my primary specialty today. And it's a market that I invest in. I use the Invesco NASDAQ 100 ETF QQQM. That's the one I use. It's the same thing as QQQ. It just has a slightly lower expense ratio. Regardless, QQQ is trading at a really interesting level as well. Right now, we're watching 445 support on QQQ, and resistance is at about 480. It's currently getting some resistance also at its declining 50-day moving average. We'd like to see a breakout on QQQ above 490. If we get a 490 breakout, that'll take us past the 200-day moving average, and it will put us on the other side of the market, which I think would be a pretty bullish move. And we're not too far away from it. We're currently sitting at about 470. So we're just about 20 points or so away from that new price being reached, or that breakout moment for the NASDAQ 100. Now let's turn to gold and silver for a minute, precious metals, because gold had a parabolic run there for a bit. It ran all the way up to $3,500 an ounce, and gold prices took a pretty sizable hit last week as the markets rallied and gold backed off. I think there is a case to be made that this correction was way overdue, right? We still have a huge long-term uptrend intact for gold, but the correction was way overdue, right? And now we're getting it. And gold is but it's still hanging tough. It's still sitting up around the 3,300 level or so after backing off of that 3,500 high. And also, one thing to keep in mind too is that silver tends to lag gold, but then it kind of plays catch up. Right now, the gold-silver ratio is still sitting at 100-1. That's really out of whack, guys. I mean, you go back historically for the last 30 years, it's averaged 70-1. Go back even further, it's even lower. And that ratio means that it takes 100 ounces of silver to buy 1 ounce of gold. I mean, that's really extreme. You don't see that too often. I mean, there's only been a few times in history we've seen it that extreme. So silver does tend to play some catch up, over time. And we think that gold is probably going to take a while to lick its wounds here after that parabolic run and then a back off. And now it's just kind of grinding and consolidating those big gains. I don't think we've seen the end of the dollar rally. Of gold rally. I think that, gold can move on to 4,000 and even 5,000 in the coming years. But I think right now we're probably going to take a little bit of a break as we've had just this breathless rally moving us higher. If we look at silver, as I was mentioning, though, silver is another one that we continue to watch. And it's currently trading above its 200-day moving average, which is currently about $31. It's trading at about 33 as we speak. So it's a couple bucks above that 200-day moving average. It's still sitting below that $35 high that we got back to, back in October of last year or so. So I think there's still plenty of upside room for silver relative to gold. I think gold still has plenty of upside over time, but I think silver may be the winner here in the near term regarding these two metals. And then also, I want to take a look at the U.S. dollar, because the U.S. dollar it's becoming a crowded trade now. We had talked about how we expected the dollar to come down. The dollar index came down very sharply. It was trading at 110 back in January. It is trading below 100 now. It's trading at about 99 now. It got as low as 98 last month, or I guess it was, earlier this month, I should say. And so the dollar, has also really been hit, and that is also problematic, but also at the same time supportive of certain asset classes like precious metals and even things like Bitcoin. And so we do expect that the dollar has more downside, but it's really met. Both gold and the dollar kind of met our 2025 expectations already, and we're just here at the end of April. We had expected gold to get to 3,200 this year. It went to 3,500, so it surpassed our expectation. We had an expectation that the dollar would fall down to the 99 to 103 zone, and it already did that. Let's talk also about Bitcoin, because we also have strong expectations for Bitcoin going forward. As many of you know, that's a market we've been following now for many, many, many years. We were one of the very first podcasts to even talk about Bitcoin way back in 2012. Now, Bitcoin is still trading below its peak of about 110 that was reached late last year. We think that Bitcoin is going to go on to go past that 110,000. It's going to hit a new fresh high this year. And we think it's actually going to go above 200,000 this year. So that's going to be quite a rally if that does play out the way we expect. We expect that Bitcoin does have quite a bit of upside still ahead. And there are many people who are still uncertain about Bitcoin, and that's totally understandable. But that's not the only cryptocurrency we're watching. We're also watching Ethereum, expecting it to do well this year as well. It's already had a very tough year. It's opened up the year very brutally down. I mean, think about it. At the very beginning of the year, Ethereum was trading at 3,400, 3,500, somewhere in there. Now, it's trading at half that. It's trading at like 1750 or so, which, by the way, is a very key level. 1750 is a major support level here for Ethereum if you're watching that market. So, in summary, the markets are certainly feeling the stress from the trade war and the tariff shocks and the slowing economic data for sure. But be careful not to get too stuck looking backwards, because the economic data, obviously, as we said, is backward looking. It's historical data. We really want to stay disciplined in this current environment and watch these charts closely, especially when these clear signals begin to emerge so that we can act decisively. Chaos always brings opportunity, and the way we can spot that opportunity is by following the trends. And that's one thing we do very well here at Follow the Money, is we teach our members how to use trends to profit, whether they're trading or whether they're investing. Trends are really very important. They're much more important than opinions. And again, opinions are a dime a dozen, but trends, don't lie. They may change, but you can see them change. You can spot the change. And that's what's great about them. So if you would like to get help in terms of that, be sure to check out followthemoney.com. We even have our own trend trading software called the Profit Tracker software, where you can type in any ETF, any stock, anywhere in the world, any global market, any commodity, many cryptocurrencies are covered, and you're able to look and see what's the current trend of that particular asset. And what's even better is that we alert our members when these trends change. So when you have a new long-term uptrend or a new position uptrend or a new swing uptrend, these are all, we provide that every single day. We keep our members on the right side of the trend. So there's a little wrap up of what we're seeing. I encourage you to keep your eyes peeled for opportunities. I think there's going to be a lot of opportunities here. There already are many. A lot of investors are trying to seek safety because they're worried about the economic uncertainty. But as I said, the stress in the markets creates opportunity if you know where to look. So you're probably doing fine out there. You probably got it, all figured out. But if you do want a little assistance, we're always here to help. Followthemoney.com. Check out our plans and pricing page and choose a plan that's right for you, and come join us as we navigate these markets together. All right, friends, welcome back to the final moments of today's episode. As we wrap up the show today, let's just quickly revisit the key themes we talked about. We've clearly seen that the economic data from Q1 is flashing a warning sign. We have GDP that's contracting. We've got consumer spending that's slowing. We have the jobless figures, which we'll get the latest update there for April this Friday. But based upon the ADP report we got, it's not looking so hot. And then on top of all of that, we have the Trump tariffs that have become a drag, really pulling forward imports and leaving uncertainty and volatility in their wake. So we shouldn't be surprised here to see that markets are jittery and investor confidence is shaken, and that many businesses are simply rethinking their next moves. But remember, uncertainty breeds opportunity. The most important thing to do here is to stay flexible, in my opinion. We want to let the market data and the charts and the clear technical signals drive our trading and investing decisions, not emotional headlines or noisy media or the opinions of the hoi polloi. In fact, this discipline is how we keep our edge, especially when uncertainty dominates the landscape like it does today. Now, as always, I like to leave you with a final word, and today I'm going to leave you with a good insight from the legendary management guru Peter Drucker, who said, "The greatest danger in times of turbulence is not the turbulence, it is to act with yesterday's logic." It's a very powerful statement, obviously for managers, but also for traders and investors. In other words, friends, stay nimble. You really have to be ready to adapt. But keep your thinking fresh and not get stuck with that recency bias. That way you keep your strategy aligned with the realities of today's market. And that's just something to think about. Don't forget, friends, if you're looking for ongoing guidance and deeper analysis or fresh trading and investing ideas, just head over to our website, followthemoney.com. We got a great community here dedicated to staying ahead of the trends together. We'd love for you to join us. Thanks again for joining me today, and until next time, my friends, remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.